Good morning, everybody. Good morning to UK Property Talk. This is Charles Kelly. I'm reporting from London, where it's a sunny spring day here, and the market here is well. I'm going to go straight into the market report now. The market is starting to slow down in property. So what we do on this event, we record this and put it out on YouTube as well. But we talk specifically about property, about where the market is going, what opportunities there are in the market, and just generally things about property in itself, whether property is a good investment, whether this is a good time to buy, not a good time to buy. There's very different ways of looking at it. So first of all, let's look at the market. The market has been slowing down. Now, I'm not just reading what's in the news. Obviously, the news is saying this. A nationwide report came out fairly recently saying that the market is likely to slow down. The Nationwide is one of the biggest lenders in the UK. Now, they're obviously not going to say the market will crash. It's not that they think that, but they always say slow down, level off, calm down. They use words that are not going to shake the market. They're saying it's slowing down. Estate agents I talk to in and around the area are all saying that things are slow. Now, they've had a good couple of years, obviously, with the boom that went on during that lockdown period, but now they're finding that things are definitely slowing down a lot now. So that's the situation here. I guess we would expect that, because we've had such a busy time in the last couple of years where people were just scrambling to buy properties, and properties went up by about 20%. But now it is slowing down, and one of the reasons for that, I think, is the economy. The economy has been slowing. We were expecting the economy to grow, but it's starting to get into negative figures. Last month, it contracted by just under 1%. But the US economy also contracted in the first quarter. Now, if they have 2 quarters of negative growth, then that is officially then a recession. China is slowing down. China has reduced its mortgage rate to try and stimulate the property market. Of course, in the last couple of years, we had that big scandal going on with Evergrande defaulting on its bond payments. Now, they're building in China, but I think they're listed on the Hong Kong stock market. But they borrowed billions. I think it was 200 or 300 billion they borrowed from institutions, and they were defaulting on the interest payments. And that wasn't the only company. Now, if this had been in the UK, I think they would have gone into liquidation now. But somehow the Chinese government have kept that under, kept that under the lid, and managed to suppress that story. But that's not over yet. They've built thousands and hundreds of thousands of properties that have been unsold, and there's whole cities that lie empty. So there's big problems there as well. And then we're seeing inflation on a scale that we haven't seen since the 80s. Inflation hit 9% in the UK this week, which was a 40-year high, which is quite something. And that is taking money out of people's pockets. Fuel bills here, in some cases, have doubled and even trebled. So where people might be expected to pay, £1,500 a month, they're now paying, £3,000 and even more per annum. They were paying £1,500 per annum. Now they're paying something like £3,000 to £4,000 a year just for electricity and gas. So you can't live without that. So that is taking disposable income away from the market. So we are seeing a definite slowdown. Having said that, there's still people with money. There's still people who are able to go out as first-time buyers and buy a property for £750,000, a normal sort of semi. It is crazy. My lawyer was telling me yesterday that there was a property went on sale in St Albans, which is a nice town, city just outside of London with a fast train link. It's got a cathedral. That sort of, it's a nice place to live. And it was listed as one of the most expensive places to live in the country compared to income ratios. I think it was something like you needed 14 times the average income to buy a property in St Albans. And he said there's an ordinary semi on sale that he's dealing with, ordinary semi-detached house, not necessarily in the best part, but it's quite near a school catchment area. That's the big thing. If it's near a good school and the middle classes want their children to go to that school, they have to live within the catchment area. And it was on the market for something like £975,000, which is already a lot of money, but it actually sold for £50,000 more than the asking price. So it sold for over £1 million, which he couldn't believe. It was just crazy. There was a sort of bidding war to get this property. So there are people with money to buy property, but the general public and people at the lower end of the income scale and the people in the middle really are being squeezed gradually. Incomes are not going up fast enough, but inflation is running at 9%. Now, we say inflation is running at 9% because that's the official CPI figures from the ONS. But if we measure inflation the way we used to measure it, it would probably be at more like 18% right now. And also, if you look at the retail prices index, which they don't use anymore, this is the price of all goods aside from property, so it doesn't include property and rents, but that's going up by 13%. So this is why when you go in the shops, you know that you look at things that you bought a year ago and they've gone up by 20%, or the packaging's got smaller. Petrol, fuel is at record price, $1.65 a litre in some cases, despite the tax cut that the government made. A lot of people saying this is because of the war, but really it's because of the sanctions imposed on Russia that's stopping oil and gas being exported, it's stopping wheat being exported. So it's causing food shortages in part of the world, and it's causing prices to just rise. But the real inflation problem came about because of the massive amounts of money printing that's gone on, not just since 2020, but since 2008, where they brought in this term called quantitative easing, QE. A lot of people just say it's a term for money printing. This was to get us out of the last financial crash and to stop the world going into a big recession. And they've artificially held up the economy by pumping all this money into the economy. And that's raised asset prices, but it's now having an effect on inflation. Now, in history, we've always seen that inflation means big problems for countries. But when you print a lot of money, it causes inflation. The German Weimar Republic, we saw this in Argentina, we saw this in Venezuela and in Zimbabwe, where they destroyed the currency. Mugabe more or less destroyed the currency, and people were using dollars and rands. So that inflation is causing massive problems for ordinary people, and it's taking money out of their pocket, which means the market's slowing down, the economy is slowing down, and people may not have as much money to spend. But having said that, properties in the right area, the right kind of property is still commanding a lot of interest. You'll still get buyers for it at the right prices. Flats have definitely slowed down. I'm getting lots of estate agents calling me saying this flat has been reduced by 30,000, 40,000, 50,000, been on the market for a while. But 3 and 4 bedroom houses in nice suburbs where you've got a bit of land, bit of garden, good train links, definitely still popular, and agents cannot get enough of those type of properties. Now, of course, estate agents make their money by the volume of sales, and if the volume of sales is down, then their business is down. And that is what's happening here and in America, where lending is down. Some of the big lenders have laid off staff because they're not getting the refinance market. So there are problems ahead. And if estate agents are not getting the volume, then they're not getting the income, because they don't make that much more money. If a property sells for 50,000 more, it doesn't really matter to them. It's just a small percentage increase to them, but they need that volume. And when I walk around, I'm seeing estate agents say, well, look, the phone's not ringing. It's just very slow. And they've got overheads. They've got rent to pay on their shop premises. And there's been an explosion of estate agents over the last 10 years in high street. You can see great big shops being taken over, massive amounts of desks in there. They're all sitting there like soldiers beavering away. But that's expensive to run. If you think of just an ordinary shop in a suburb, not right in London, maybe the rent's 25, 30,000 a year. Then you've got council tax on top of that. Call that 15,000, 45,000. Then you've got your utilities and all that sort of stuff. So you're looking at 50,000 a year before you've opened up the door. That's £1,000 a week they've got to find just before they've even opened up the door and started trading. Then they've got staff, then they've got other things going on, taxes, and so you're looking at 80, 90,000 a year operation. So they've got to sell quite a few properties every month. If they've got to make, say, I don't know, £2,000 a week, well, they've got to sell a property every week just to cover that. So it's not that easy. So I think some estate agents are going to be struggling. I've seen one or two close down, maybe slim down their branches. So they are going. I know a lot of people don't have much sympathy for estate agents, but they're not the most popular people in the world. But we need them when we're going to sell a property or rent a property. Now, you may have heard of a company called Purple Bricks. They're an estate agents that work slightly different. They say we have low fees and we don't charge as much. But what they do, in fact, is just take money up front and then put your property on the market. The service I find is poor, but they've made a lot of money. They've grown rapidly, but then they expanded into other countries, I think particularly America, and it hasn't worked out. And they're not getting the volume of sales. So their share price has literally collapsed, and we don't know whether they're even going to survive. And yet they're on TV all the time, spending fortunes on marketing, but not getting the volume. And I found, compared to a traditional estate agent, I don't think their service is very good. I've tried to view properties through Purple Bricks. I've gone there, there's nobody there. That's it. I've gone all the way into London to view a property, and it's just no show, nobody in, nobody there. And then you try and get back to them. It's very difficult. So I haven't had much luck with Purple Bricks. Maybe your experience is different. Tell me if you think your experience is different. So but they're one of the biggest in the market. They've got a very large share of the volume. But having said that, their volume is based on taking fees up front and then putting your property on the market. Whereas a traditional estate agent that does not charge you anything up front, they'll do all the marketing. They'll take photos of your property. They'll do the measuring, the floor plans, make sure you've got the EPC in place, make sure that you can legally sell the property. Well, I mean, they're not checking land registry, but they check money laundering and that sort of thing. And they kind of get you set up, and then they vet buyers. They make sure, that if someone's going to say they will buy that property, they sort of do a bit of vetting to make sure that person is capable of buying that property. They've got a mortgage offer, or they've got cash, sight of cash, that sort of thing. If they haven't got a mortgage offer, they'll perhaps help them get the mortgage. So, and then they're transacting the whole process through from start to finish, which can take 6 months. They're perhaps dealing with, the buyers' viewings and surveyors and getting that type of thing sorted out, and dealing with solicitors, making sure that the solicitors are instructed. If you've ever tried to sell a property yourself without an agent, you realize that there's a lot of work that goes on in the background that you don't see. And then managing a chain of transactions, because you're buying something, but then the person you're buying from, say you're a first-time buyer, you're buying a flat, well, the person in the flat might be selling that flat and buying a house, and then the person in that house is upsizing to a bigger house. Sometimes there can be 5 or 6 transactions going on in a chain, and they all need to sell on the same day, exchange contracts on the same day, complete and move on the same day. So if one person in the chain falls down, like their buyer drops out or they can't get a mortgage offer, the whole chain can collapse. And often the estate agents are working together to keep that chain in place or replace the broken links, as it were. So there's a lot of work goes on in the background. And then at the end of it, they could work for 6 months, and then the chain collapses, somebody pulls out, their buyer changes their mind, finished, or their seller changes their mind. So they don't get paid until the very end, whereas Purple Bricks are getting paid up front, and there's other Purple Bricks type models that just get their money up front, and that's it. You paid and finished. So yeah, maybe it can work for some people, but Purple Bricks are definitely in trouble. The other sign I'm seeing with the market is that surveyors, and surveyors are people that do the surveys when someone gets a mortgage arranged. Now, when you buy a property cash, you can appoint your own surveyor to make sure the building's sound, and you can have various levels of survey reports. You can just have a mortgage valuation, very basic. They'll spend half an hour there, check everything's intact, and give you a valuation. Then you can have a home buyer's report, which is more detailed. I would suggest everyone should at least get a home buyer's report, because a mortgage valuation is nothing. And then there's a full structure where they really go into a lot of depth and dig up, look under the floorboards and that sort of thing. And they're more expensive, obviously, so that the higher the level, the more you pay. Most people just have a mortgage valuation. And I'm finding that surveyors are now starting to downvalue properties on the mortgage valuation. So somebody puts a property on the market for, say, 500,000, the estate agent says, yes, we can get 500,000 for you. And then the buyer comes in, offers, say, 495, they accept, and we think you've got a deal. And the estate agent thinks, great, we've got a deal. But then they get their mortgage arranged. The surveyor comes in and says, no, I'm not going to value this at 495. I'm going to value it at 475 or 450. And this is happening. I've seen this happen before. It doesn't happen in a booming market because valuations are always going up, and they just value things at the asking price. But now, when things are slowing down, maybe the lenders are telling them to do this, or maybe the surveyors are just covering their backs because they don't want to get into trouble with the lender if they overvalue properties. So they're now downvaluing things. Then what happens? Then the buyer says, well, your property's been downvalued. And the seller says, well, I don't care, I want 495. That's what we agreed. And then there has to be this negotiation. And this is where the estate agent can help, because people can get very heated in these situations. Whereas if you put it through a third party, it's like an arbitrator or like a judge in between the two parts, a bit like counseling. They're there in the middle, and they then can negotiate with the buyer and the seller to smooth things out, maybe meet in the middle. So that is happening at the moment, and I've definitely seen this before. We're also seeing slow service with things like getting land registry registered, and local authority searches are taking an awful lot of time. This is perhaps because civil servants are more working from home, right? This working from home, that the government's had this argument with them recently that they want them to get back in the office, and civil servants don't want to go back into the office. They like working from home. They like being able to do their washing during the day and pick up their kids from school and feed the dog and feed the cat and that sort of stuff. They like working from home. They don't want to go on that train into town and work in a sweaty office, do they? They want to stay at home. And the government's having this argument with civil servants who are refusing to go back to work. Right, I don't want to get political about that, but as I said, we are seeing a very slow service there. So what about property in general? When is a good time to buy? When is a good time to buy? I think there's two arguments there. Some people are waiting for the big crash. They're waiting for a dip. They're waiting for the bottom of the market, like in the stock market, you wait for the dips and you buy on the dips and hope it's going to go up. And then when it's high, you're trying to sell to somebody else. You're trying to sell to someone else and leave them to hold the baby, and then you get out, But it doesn't always work like that. In property, it's a much slower movement of the up and downs. Stock markets, you can see going up and down like that. I mean, this week, stock markets in the US had their worst day since 2020, since before the lockdown. That was the NASDAQ, went down by nearly 5%. And then in the next couple of days, it went up again. So I think it ended the week in sort of positive territory after a terrible week. So stock markets can go up and down like the proverbial yo-yo. So the NASDAQ ended yesterday at just 0.3 down. It was slightly in positive during the day. 0.3 down, and the Dow Jones was the same amount, but slightly in positive. So they had a terrible week, but that is a sign that the market is getting nervous, and stock markets have declined in the last few months. Certainly year to date, some of the American stock markets have declined by 18 to 20%. So that's not a good economic sign. That means that investors are nervous. They feel that fundamentals are wrong and that we're heading into recession. Now, property takes much longer to react to that situation because at the end of the day, people still need somewhere to live and there's still a market there. But eventually property does tend to follow a stock market crash. Now, we haven't had a stock market crash, but we're certainly in correction territory there with the stock market. But what I've noticed in years gone by is that if there is a big stock market crash, like the 87 crash and other crashes, property then follows maybe 6 months to a year later, and then it just goes dead. And then if there's a property crash, it can take 5-6 years before it comes back. Whereas the stock market might come back in a year or two because investors want to get back and buy cheap. But the property market can be slow. However, a lot of people are saying that, well, no, this is not going to be the case this time because institutions are now buying properties and they're getting into the build to let and buy to let. And we're seeing Legal and General and in America, Goldman Sachs, BlackRock buying properties to rent out. And of course, that's been pushing up prices because they can buy whole blocks of flats. They can build whole blocks of flats. And I think that has not helped ordinary consumers buy properties because they are big landlords. And I don't think they always buy very sensibly. If I was buying some of those properties, I may not have bought them. I may not have paid those prices. And then they've got all their management charges. They've got to employ people with company cars and big salaries, and they've got to employ people to manage those properties. So will they make a profit or not? I don't know. Some people say that when institutions go in and rush in to buy things, it tends to end in tears. But that might keep the market going because there's still an interest in property. Also, in the UK, at least, there is still a shortage of property. They need to build 200,000-300,000 properties a year, and that's not quite happening. And people still need somewhere to live. The population is still going up. Immigration has slowed down, but we're seeing still a lot of people coming across the channel every day. Hundreds of boats coming across the channel, like an invasion in the war. It's like a wartime invasion. So there's still immigration there, and there's still a skill shortage here. There's still a staff shortage here. They still need highly skilled people coming into the country, and that will continue through the work permit system. Nurses, medical people. I don't know what the shortage occupation list is now, but they still need people. So, there still will be a demand for property. People are living longer. There's more divorces, so people want single units. So that creates a need for two properties if a couple split up. So I believe that I don't see a massive crash, but definitely a slowdown is coming. But then you just don't know what's happening. I mean, look what's happened in the last couple of years. We didn't expect it. Will this war escalate? Will it go on? Will it cause other problems? We just don't know what's going to happen. So you can never be really sure exactly what's going to happen, what the government are going to do, what the central banks are going to do, and how they might pump money to inflate the market, how they might stimulate the market by cutting rates or bringing in new schemes to help people buy. I mean, there's talk of a new scheme that will be coming in. I'll just quickly look that up. It's like a scheme to help first-time buyers that's been reported. I haven't even really looked at this in detail, but it looks like there could be a new plan to help first-time buyers from the government. So these sorts of things can, a new plan to help first-time buyers get cheaper mortgages unveiled. So these are things that you hear these announcements, but it takes time to come through. Announced by Michael Gove, the Housing Secretary, examining the Canada-style plans to make loans more available for those without big savings. Now in Canada, of course, we've got a massive bubble happening there in Canada and Toronto and Vancouver. We've got similar things in Australia and New Zealand. The government is looking now at other countries that allow more families to get loans with small deposits and will fix our dysfunctional housing market, Michael Gove said. I didn't know it was dysfunctional. I mean, traditionally, banks like people to save money for a deposit and put some deposit down, then they have more skin in the game, as it were. If we're going back to 100% mortgages, that's where you had previous bubbles in 2008 and in the 80s, when I remember where you could get mortgages up to, well, certainly 100%, then it went up to 125%. But in those days, lenders had a guarantee. They had a thing called a mortgage guarantee policy, which would protect them in the event of high percentages loans going into default. I think the insurance companies then pulled out of that market. But that's all they need to bring back is a mortgage guarantee product from an insurance company, so that it guarantees the lender if they lend up to, say, 95 or 100%. But if 100%, so this is the thing, if the markets slow down and then the government bring back 100% mortgages, or lenders start lending wildly again, that then can pump the market up. So who knows what is going to happen? So I'm sorry to be a bit vague on this, but I can't give you the definitive answers, and no experts can. I've listened to various experts. One says it's going down, it's all doom and gloom, and the others said, no, don't worry, everything will be fine, don't worry. I certainly think the stock market is due for a correction and maybe a big crash. Cryptos we've seen get into trouble, and I wouldn't even touch them anyway. So there has been a lot of crazy money chasing things like crypto, NFTs, whatever they are, fungible tokens, digital art, all these silly types of investments. Sorry if you just bought one, but a lot of very rich merchant bankers with more money than sense, and so much bonuses that they just don't know what to spend it on. But property has always been stable in the long run, and that's what I'm trying to get round to, is that whatever happens in the short term, people will still need somewhere to live. Certainly in the UK, that the economy will survive Brexit. It will survive. It will get back there, even though it's faltering at the moment. There's a lot of talent here. There's a lot of good brains and talent in this country, and it's always been a trading nation. I think it will survive and thrive post-Brexit. So there will be a need for people to live somewhere in property. And so even if there's a dip in the short term, then I think it will survive in the long run. And if you look at any chart on properties and the stock market, you'll see that the trend is always upwards, because people need somewhere to live. And I think if you're buying a property to live in for yourself, for your family, then it doesn't really matter whether you buy at a slightly higher price now and it goes down. Because if you're going to be in that property 5-10 years, what does it matter? If you want to get the property that you want now, your dream house, just get it. Excuse me, I wouldn't wait for a dip to buy a property that you are going to live in. As long as you get the right mortgage, you can afford it. You buy, with a good mortgage and maybe a fixed rate, certainly 5-10 years, fix your rate so that you will not be hit if rates go up. Then you're safe. And as long as your income stays stable and you're not overstretching yourself, I would still buy, as long as you're not overstretching yourself. As I said, if you're really going into debt up to your neck and struggling to buy that property, then, and you haven't got a stable job, you're not a civil servant, then, who knows, you could get yourself into trouble. But if you're buying a property to live in and you're able to do it, you're upsizing for family reasons, you need a bigger place, you've got a growing family, you need to move from that flat into a house, then yeah, if you can afford to wait, but otherwise just get it. It's not just about the money and the value of the property, it's about your lifestyle and where you want to live. So I would just go for it. Also, if there is a massive property crash, then lenders will also pull all their products like they did in 2008. And like in the 90s, they made it very difficult to borrow money. So they go through this period of turning on the tap and throwing money out there, lending 5, 6, 7, 8 times income, 100%, 125%. And then they get their fingers burned. They don't remember what happened before. And then they start pulling in their reins and they stop. Oh, no, we can't lend now. Oh, no, we've got to be careful. And then when the market is at the very rock bottom, they're not lending. They throw money at the market when it's at the top, at the peak, but when it's at rock bottom, they almost sort of stop lending. So that could happen again. So if you wait for when things are tough, you might find it's more difficult to get a mortgage. Now, if you're buying to buy to let, or you're buying as an investment, then maybe you can be a bit, you can wait a bit, you can be a bit more discerning. You can say, well, I'll just wait and see what happens if you're not in any rush. But if you're going to wait years and your money is sitting there in the bank earning next to zero, then you're finding that inflation is pushing the value of properties up while your money is losing value by 9 and 10% a year. And if you think about inflation just for a second, inflation means that the value of things, the price of things are going up. That's not the technical term for the word inflation. But in general, in an inflationary era, assets go up and the rich get richer and the poor get poorer. And that's been happening. So in theory, properties will go up in an inflationary period, right? It's not automatic, but assets generally go up in inflation. And that's why you should invest in assets, not bank accounts. If you put your money into a unit trust fund or a pension fund, they will generally be investing that money into assets, not sitting in cash, because cash will lose value. It's good to have cash, of course, but it will lose value over time. So if you imagine properties going up by, say, 9, 10% a year, so the average property over a year might go up by, and the average price in property here is nearly 300,000. So prices could go up by 20, 30,000 a year on average. It's not to say it will definitely happen, but over time, inflation will push the price of the property up. Now, if you can buy that property and borrow at, say, 3, 4%, and inflation is at 9, 10%, then there's obviously, you're making a bit of money there. If rates are going up to 10% again, like they were in previous high inflationary times, then maybe you're not quids in there. But at the moment, you've got low interest rates and higher inflation, which in effect is inflating the value of the property. So in effect, that should be a good investment. And maybe that's why the institutions are going in and buying up stuff, because they can borrow money at very low interest rates. They can raise money from investors at very low interest rates and buy assets that will give them an income and should go up in value over time. And that's the other thing with investment property, is that you're getting an income as well as growth. And in the bank account, they're just giving you a bit of interest. So in some ways, it doesn't matter whether the price of the property is going up or down, as long as you're getting your rent and you're getting your income. Like a share, you buy a share in I don't know, Amazon, you're getting a dividend every year. You're getting a dividend from Tesco shares, and in some cases 3%. I'm not saying that's the exact rate, but you could be getting a dividend that's far more than interest payment, and the share should grow in time. If the share value goes down for 1 year, but you're still getting your dividend payment, then people tend to hang in there and just stay with it. So getting back to inflation, that it could be very good for people who own property in the long term, but bad for people who are trying to struggle to make ends meet. But what about the effect of inflation on a mortgage, on debt? What about the effects of that? The government now owe trillions. I think the national debt here is 2 trillion, but they are going to be paying that over time. And a lot of that is based on government bonds and gilts. So they're paying those in bonds. But over time, that debt, by the time they pay back that debt, by the time they pay, say they've got a £1 billion bond that they've issued over, say, 10 years, or the US Treasury 30-year bond, which is paying, I don't know, 1%, say, they're paying that back to you in 30 years' time. So if they raise £1 billion from that bond and they're paying it back in 30 years' time, is that $1 billion that they're paying back, or the £1 billion that they're paying back, the same now as it was then? No. $1 billion is a lot of money now, and it will still be a lot of money in 30 years' time. It's not going to be the same value, is it? It might be just a quarter of that value in 30 years' time. Let's say every 10 years of inflation, reduces that by a half. So maybe it's only worth $250 million. By the time you get that money back in 30 years' time, it's not worth as much. And it's the same with your mortgage, really. I've met people that said, "Oh, I bought my house in 1980, whatever, and I took a £10,000 mortgage. It was such a big mortgage, but now it seems like nothing. You could pay it off on a credit card. So, you know, my mum bought a house in London. I think she paid £25,000 for it. And the mortgage was huge at that time. It seemed like a big interest rates were high at that time. I mean, she's paid it off now. But imagine if she just left it as an interest-only mortgage and she only had to pay back £25,000 now. It's like nothing. You know, you could almost do it on 2 or 3 credit cards. So what I'm saying is that when you're borrowing money and you have inflation, it actually works to your advantage in some ways because it's inflating the value of that debt away. And this is what governments are banking on. This is why governments can just raise money on the bond market and they're paying it, you know, over time. They're paying that back and it won't be worth as much to the you might say, well, why do people invest in bonds? Well, institutions invest in bonds because they want that guaranteed return. They have so much money to invest because people are putting the money into pension funds and they have so much money to invest, and they have liabilities as well. So they have to cover those liabilities with guaranteed returns. You know, they have so much billions and trillions that, you know, at the end of the day, the only safe institution is the government, because they know that the government will not default on those payments, and the US has never defaulted on a bond. But the returns for an investor are very poor. There are times when bonds can go up, and you know it's not a market I invest in, but there are sometimes a good time to invest in the bond market. But you can see what I'm saying is that the value of that money paying back is devalued by inflation, and so the government are also banking on that. And of course, the government can also print their own money to pay the interest and pay it back. So they're even printing their own money, and that's been devalued as well. So they're paying back with almost sort of phony dollars in the end. It's a crazy system, really. It's almost like, as Robert Kiyosaki calls it, fake money. They're just producing money out of the air. And so that's why a lot of investors want to invest in real assets, not cash. So they want to invest in property. They want to invest in gold because they feel it's more tangible, it's more real. And that's why a lot of people over the last few years have put their money into cryptocurrencies, because they think that is safer than US dollars and cash. I don't agree with that. I think that's as Warren Buffett called it, a mirage. But you can see how investing in assets is very different from having your money sitting in cash. So that's another way of looking at it, is inflation can work to your advantage as an investor and as somebody borrowing money. So maybe the answer is, you know, there are some people out there like Robert Kiyosaki that just believes in just debt. And he just keeps raising money against the value of his properties because he said it's tax-free. So yes, if you have a property and you've got a mortgage on it and it's gone up in a year and you just draw, you increase the value of that mortgage, you just keep drawing off. That money is tax-free, of course, but you know, you're obviously adding to the debt. But he doesn't kind of care about the debt. He doesn't mind if he's got £1 billion worth of property and $500 million or $750 million in debt. What does he care? As long as the debt has been serviced by the rent, he's still got assets there, and the assets are going up in value. So he's kind of used debt to build his wealth, as people like Grant Cardone has, as institutions have, as institutions and people have done for centuries. They've used debt and other people's money to build wealth. Whereas most people say, no, I'll save up and pay everything in cash. Yeah, I'd advise you to do that on consumer debt. But in terms of using debt to buy assets, then leverage has been the greatest thing for the property market, because you can use leverage to buy property as an investment, which you can't do so easily in the stock market or cryptocurrencies. And why would you? You know, why would a high street bank lend you money to buy Bitcoin or buy, you know, Amazon shares when it knows, when you're saying, yeah, we'll give you that crypto as the security, or we'll give you the shares as security? They won't do it, but they'll do it for a property. So you say, I've got this property, I'm buying that. I'm buying that for £100,000. Give me £80,000, and you can take security on the property, you can take a charge on that property's deed, the property title. That's called a mortgage. That's exactly what they do. And then you pay that lender back over time. And that's called a mortgage. Yes, so that's called leverage. And people have been using leverage for centuries. That's why I wrote in my book, Borrow and Grow Rich, which I've published not that long ago. It's about how people have used other people's money for centuries. And I quote here, the tale of two friends. One is financially free and the other is working. And in fact, one of these friends of mine was a saver. He used to put all his money into managed funds and mutual funds, pensions, saved to the maximum. And he lived in a nice detached property in Surrey. But the other one didn't put his money into those sorts of investments. He bought property. He used debt to buy property. He didn't have that much disposable income. So he bought his first property, lived in it, rented out a couple of rooms in the property, and then found that he could easily pay the mortgage. And then he repeated the process. He rented that out, managed to raise a bit of money to buy another property, lived in that. And then he ended up with about 5 properties in Docklands. He bought them during the recession in the I guess that would have been the 90s or the early 2000s. And that they went up in value. And he did massively well. So he built all of his wealth on debt, and he's financially free, semi-retired. The other guy is still working. Now these people actually exist. They're actually friends of mine. And we would debate on a Sunday morning, and one would, I'd be on the side of the guy raising debt, and the other one would say, no, property is not very good. I put my money into managed funds, and he's done very well, but he's still working. He's in his, I think he's already 65. I think he's waiting for the last year of his work to be able to retire. He's already had one heart attack crossing London Bridge on the way to work, rushing across London Bridge with all the stress and that sort of thing, going to work. He hated his job. On a Sunday, he would say, I've got to go to work tomorrow. I hate it. But he was a highly paid accountant working in the city, but he hated his job. So he was still working. He did buy one property, but then he sold it. And I think he kept one other property, but he wouldn't use leverage. He wouldn't keep, I kept talking about leverage. I kept talking about debt. And he in the end, he got mad with me. He said, shut up, almost able to piss off or just stop talking to me, He got fed up. And years later, he admitted that he should have been more adventurous and bought more property and used more debt. And as they said in Rich Dad, Poor Dad, his mythical, I don't know if it was real, but his so-called rich dad said to him, think about this. How long would it take you to save $1 million? I mean, ask it, how long would it take you to save $1 million? If you're saving it every year, a long time, right? But how long would it take you to borrow $1 million from the bank and go and buy an asset and invest that $1 million? Think about that, right? And if you're credit worthy and you can raise that sort of money, you can make money by buying assets. And that always stuck in my mind. How long does it take to borrow $1 million? And when I bought my first commercial property and we raised a huge mortgage, I thought, this is amazing that you can just walk into a bank and they come out to see us, and they were happy to lend it. I thought, it's amazing. They lend us hundreds of thousands of pounds to buy this property, which we eventually sold for over £1 million and got rent from it and did very well from this commercial property. So there are definitely ways of using leverage that wealthy people have used over the centuries. That's what I write about in this book. I write about things like sending ships to discover America. They raised that through other people's money. The king raised that. The Magellans and the Galileos, they went to the king and said, I need, maybe in those days, the equivalent of millions of pounds to build boats and ships and sail to the new worlds and bring back gold and, plant your flag there. Well, the king then financed that, or the government of the day financed that money. How did he get the money? He didn't have it from his back pocket. He taxed the people to get the money. So it's all about using other people's money. And that's what very wealthy people have done for centuries. And wealthy people actually then would probably use other people's money in even more creative ways, because they would raise money on the stock markets. So they would find ways of raising money on the markets or through bond issues, like Evergrande have done. They've raised billions of dollars through bond issues, where they're just saying, lend me that money and I'll pay you an interest on it. It's called a corporate bond. So there's always been ways of raising money. The average person can't really do so many things, but there are creative ways of buying properties, which does not involve just getting a standard lender bank mortgage. There are ways of raising money. Now, creative ways, crowdfunding, private finance, bridging finance, or just getting together with people and raising the money, using other people's money to buy property. So even if you haven't got money to buy property, if you have the right deal, if you have the right property, you can raise that money privately, even if the bank might not immediately give you that money to buy that property. There are ways of raising money creative. It's called no money down investing, using other people's money to buy property, or using things like options to control a property without actually buying it. So an option gives you the option to buy a property, but not the obligation. Nothing new about options. Options have been used for a long, long time to buy land, where you might take an option on a piece of land for £1, £100, £1,000, and then you've got maybe 2 years to get planning permission on that land or that property. So it's an option subject to planning. So in the option period, you could at any time exercise your option to buy that property, or you could pull out of it. Options are used in the stock market as well. You can take an option on the share, maybe that you think it might go up or down, a put or a call option. You can do the same thing in property. So you might see a project that you think, well, I couldn't possibly afford to raise, £2 million to buy that property, to buy that project, to change that office into residential. But if you can obtain an option on it through the right knowledge, through the right lawyers, then and get planning permission, which may cost you a few £1,000s, maybe you could get that financed by a developer, work in a joint venture with a developer to buy that property. There's all sorts of ways of doing this. As I said, there's more than one way of skinning a cat, as they say, right? So even if you haven't got any money to start with, there's lots of ways of making money in property. Rent to rent is another one, where you lease a property, rent it out at a higher rent, maybe using serviced accommodation, maybe using the HMO strategy, housing multiple occupation. So there's various strategies you can employ to buy property, even if you haven't got your own money to invest. Yes, you can still raise a deposit, go down to your bank and buy a property on a buy-to-let. But buy-to-let is just one of many, many strategies that people have used to make money in property over the centuries. Developments, rent-to-rent, buying to refurbish and then sell on to flip. There's lots of ways of making money, and you don't necessarily need to use your own money. And as I was saying before, people have been using other people's money, which I've written about in my book, Borrow and Grow Rich, for centuries, because most people have not got rich by saving their own money. They've not really got rich just by saving alone. Jeff Bezos may have started Amazon from a garage or from an office selling a few books, but he had much bigger ideas. So he went to Wall Street. He raised, not just millions, but hundreds of millions, even billions, to grow Amazon. They didn't make a profit for maybe, I think, the first 10 years, but they kept investing because they wanted world domination. He couldn't have done that without other people's money. Facebook, Zuckerberg may have started it from his college bedroom, but he needed other people's money, institutional money, to grow that business. Google was the same. Microsoft, whether it was from institutions, angel investors, venture capital, or using the stock market to raise money. The stock market is a way of raising money. It's like going down to a marketplace and saying, here is this stock, this share. I'll sell you the share. You'll have a share in the company. I'll pay you a dividend and I'll give you a share of the profits. And then they use that money to build the business. That's how the stock market works. In the London Stock Exchange, which was one of the first hundreds of years ago, would raise money in that way. And so other people's money has been used for centuries. So if you haven't got any money to invest in property, don't let that stop you, because there are ways of doing this. Now, maybe you need more instruction on this. You might think, what's he talking about? What's all these strategies? What's options and that sort of thing? If you need further help, there are courses you can take. There are even free courses you can go on to learn about this. And maybe I'll put something up in the chat. There's a free virtual webinar coming up called Beginners Property Secrets. It's a virtual event on the 24th of May. I've already recommended it to some people I've spoken to before, that in my coaching and that sort of thing. But I thought about mentioning this today. I didn't mention it last week, but there is a session called Beginners Property Secrets coming up very, very soon. And you'll learn about the beginners property secrets, post-lockdown property investing, basically various strategies you can learn on how to get into property if you're not already in property. And I would say, even if you're in property already, it's still not a bad thing to do. I've tended to go on these courses just to kind of keep my hand in, to learn new things, because you just never know when a new idea has come up. You know, you can think you know it all, and think, well, I've been in the business for many years. What do I need to go on a beginner's property secret for? Yeah, thanks for your comment, Baskaran. I'll just put something in the chat here. Excuse me from leaning forward here. I'm just putting this in the chat, the link if you want to join that course. Now, I've got time for some questions and answers here. If anybody has any questions or wants to say anything, please feel free to join. You can sort of unmute yourself if you want. Please, maybe I need to. If you want to unmute yourself, please feel free to come in or raise some questions in the chat there. But please feel free to join in. I'll be putting this up on YouTube, so if you're watching this another time on YouTube, you obviously can't join in on the chat. But feel free to put comments in, and I will answer those comments as best I can. So, sorry, I know someone's joined us a little bit late here, but what I talked about earlier was that the general property market and using inflation as to your advantage when borrowing money and buying properties. Now, if you've missed some of the session earlier, I'll try and get it up on YouTube later on. You can find me on Charles Kelly Money Tips podcast on YouTube. So I'll try and get that up later on. I might just put a link up to my YouTube channel right now so that you can just check that out later on. If you've missed this or you're just joining now, then I'll put up a quick link there so that you can. Hi, this is Charles Kelly Money Tips podcast. That will be what you'll hear as you go in into that. Okay, excuse me a second. Bring that back. Yeah, I'm putting a link up to the YouTube channel here so that you can check. That's the general channel, and then you can look at the full version of this today. But we've gone through the market, inflation, the way the stock market's faltering. The stock market can go down very fast, but property may not follow and go down immediately, because there's still a shortage of property in the UK, and institutions are coming in investing. Now, that doesn't mean that property might go down, but in the long run, property usually goes up. But if you're an investor and you're prepared to wait and sit it out and see what happens, because the market is definitely slowing down, then maybe it's a good time to sort of sit back and wait until there's more bargains around. It's definitely been what we call a seller's market in the last year or two. Some places they put people on waiting lists. They said, yeah, I appreciate your offer, but I'm putting you on a waiting list because I'm seeing if people will offer more than the asking price. In the past, if you put the asking price in, normally people will accept it. Now there's been a scramble. That's called a seller's market. Maybe that could change, and we might see what's called a buyer's market, where the buyers the boot's on the other foot. And then the buyers are saying, well, I'll think about this. I might put in an offer, and then they put in a lower offer and get the property at a bargain price. That could happen as we move into the UK, the economy slowing down. That could happen. Because obviously when the economy slows down and people have got less money to buy and the job market slows down, property will slow down. But at the moment, the job market is buoyant and there's plenty of job vacancies, but inflation is eating away at people's spending power and buying power. So we just don't know what's going to happen in the market. But I'll just repeat, if you're buying for your own family home, I would just buy anyway, because it's not an investment, it's your home. And in the long term, it will go up anyway. But if you're buying as a buy to let or as an investment or certainly a buy to flip, you might want to be a bit more cautious in that circumstance. So I think that's, unless you've got any other questions, that's covered. It's about an hour has passed by. I hope that's been useful to you. Thanks for tuning in and joining in. If you've got any last minute questions, speak now or forever hold your peace. And if you want to go on that, I don't run this course, by the way, it's run by somebody else, but it's a virtual beginner's property guide to getting in. Maybe I will build my own course in the next month or so. But at the moment, I'm referring people to other people's courses that have worked for me and for other people in the past. So thanks for listening. Any last questions, just feel free to shout out or put something in the chat. But other than that, thanks for joining. Have a great day. Have a great weekend ahead. And happy investing, happy buying. And I will see you all again soon. Thanks for listening. Thanks for tuning in. This is Charles Kelly. Bye for now.
Bye, Charles. Thank you.
Thank you. Thanks very much. Thanks for joining. And I'll see you next week, next Saturday, 10 a.m. Bye for now. Bye-bye.